I'm going to take you through a review of 2021 for the Investment Trust, but of course, a lot has happened since then, so I will also be providing an update for the year-to-date 2022. First of all, on to performance. So 2021 was another satisfactory year, with the Smithson net asset value, or NAV, up 18.9%, the share price up 18.1%, compared to our reference index, that is the MSCI World SMID Index, up 17.8%. So we're a little bit ahead of the index in that year. That, of course, follows a couple of other good years, 2020 and 2019, and even our inception year, which was 2018. We started in October 2018. We've been ahead of the market in every period, which has led to our performance since inception to the end of last year, up 96.1% for the NAV and up 47.8% for the index. So to review 2021 in more detail, we have provided here the top 5 contributors from the portfolio and also the top 5 detractors. So I'll run through these briefly in order, and then we'll touch on the top 10 holdings, and very happy to answer any questions at the end. So Fortinet was by far and away our best performing stock in 2021. This is a US cybersecurity company. And we got very fortunate because we initially purchased this company in September of 2020. And that was shortly before the SolarWinds hacking attack was discovered in December of 2020. This was a mass hacking attack where perpetrators had managed to put malware into SolarWinds updates to their own clients, thus putting the malware into every single client system. This was enormous in scale, and it led to many corporates saying that they would now increase corporate spending on cybersecurity. And indeed they did. So not only did we get that sentiment boost in the market of all corporates stating they were going to do so, but actually Fortinet revenues were up over 20% in 2021 based on actual spend achieved. That meant that the shares were up over 140% last year, so a particularly strong move. Nemetschek is a software company based in Germany. They provide software to the construction and media industries. And actually for them, 2020 wasn't so great, but 2021 was much better, as of course the construction industry started to rebound after the COVID pandemic. And it's actually a similar story for the bottom of that contributor list, A.O. Smith, which is a US industrial company which makes hot water boilers and heaters, and they too benefit somewhat from the construction cycle. So as construction re-emerged in the US in 21 and in China to some degree, A.O. Smith also benefited. Equifax is a slightly different story. This is a US-based credit bureau, so they provide data on consumers who wish to acquire debt, and also provide information for employers looking to hire new employees. So again, as the US economy got stronger and stronger throughout 2021, Equifax benefited not only from people applying for more mortgages, but also from employers requesting more employee verification data. And then finally in that list, Domino's Pizza Group. This is, again, quite different. Domino's Pizza Group is one we've owned since inception and has had a difficult time over the last couple of years because of disagreements between the management team of Domino's Pizza Group and the franchisees who are running the stores day to day. And that disagreement has really been around a few things, primarily spending on innovation and technology by the management group, and on the flip side, the franchisees not opening as many stores as the management had hoped. What we saw was a change in management late 2020, early 21, and that new management team had gone quite far in terms of negotiations. And it was finally announced in December of last year that this new management team had reached a final agreement with the franchisees. The precise details of the agreement were not disclosed, but what matters to us as shareholders is that the franchisees had now committed to a new store opening program, which was taken extremely well by the market. In fact, the shares are up over 20% on the day it was announced. So therefore, pretty much all of Domino's Pizza Group performance for us as shareholders came at the end of the year. Looking at the detractors now, Sabre has been one that's been quite up and down through the pandemic. This is a US company that focuses on the travel industry. So they're really the IT backbone between the travel sellers, which are airlines and hotels, and the travel buyers, like travel agents and even websites such as Expedia. But the thing with Sabre is that their revenue is completely defined by the number of passengers boarded on planes and booked into hotels. And so as those fell during the pandemic, obviously so did Sabre's revenue, and that was by a degree of almost 90%. So that meant that throughout 2020, Sabre was proving very difficult in the market. And actually, the start of 21 saw a relief in that as governments started to lift travel restrictions and people were able to travel more freely. We actually saw the passengers boarded climb, and so too did Sabre's share price in response to that. But that was just at the start of 21. Of course, we then had the Delta variation and then the Omicron variation, which reimposed government travel restrictions onto the market and again held back travel, causing Sabre to be our worst performing company. Funnily enough, I've got more to say about Sabre in a moment. Ambu is a Danish company, medical devices. They focus on endoscopes, primarily disposable endoscopes. That's opposed to what normally happens with endoscopes, which they are reused by doctors to look into patients, can be used up to hundreds of times on patients, clearly cleaned each time, but unfortunately not perfectly, which does lead to higher infection rates than using a disposable item, which you literally take out, use once, and then send back for recycling. So Ambu, as you might imagine, is getting a lot of traction during the pandemic, where infection rates, bearing in mind that they focus on pulmonary in the lungs and have been used to treat COVID patients, infection rates were really a priority for many hospitals. And so they saw a big switch from reusable endoscopes to their disposable ones. And so 2020 was really a banner year for Ambu, and they did extremely well, which meant, unfortunately, that it was always quite unlikely that 2021 would live up to that stellar year of 2020, and so it proved to be, and the shares suffered a little on the back of that. IPG Photonics is a US company. They produce fiber lasers, very high-powered lasers for different processes such as manufacturing, but also raw material processing. They actually did have a good year in 2021 compared to quite a poor 2020. It's very industrial-based business. But unfortunately, we saw a lot of the share price performance, bearing in mind that the market tends to anticipate the good results coming. We saw a lot of that share price performance in the end of 2020 and just beginning of 21, which meant that by the time these results actually came through, and again, revenues for IPG Photonics were above 20% for last year, by the time that actually got printed, the market had moved on and expectations were slightly above where IPG actually achieved. Therefore, the shares again fell back slightly. And it's a similar story for the bottom of that list, Paycom Software. They too had a strong year. They produce software for small and medium-sized companies to facilitate their human resources functions so that employees can interact directly with the database in the company instead of going through HR representatives. Again, 2020 was a tougher market for them as a lot of employment markets shut down. But as 21 came round, the US economy recovered, employment came back. Paycom had very strong revenues, again in the 20 to 30% range. But because people were hoping for a little bit more, the shares didn't quite perform in 2021 as we'd hoped. And finally, SimCorp. This is a Danish company providing software to asset managers such as ourselves. And they suffered a little bit in 2021 from after effects of the pandemic. You see, the software licenses that they sell tend to be quite large as they are being sold to what is quite often a big asset manager. And so, as you might imagine, selling these very expensive licenses requires a lot of face-to-face meetings at several levels of the corporation to get that sales process across the line. And they tell us that in 2021, they just didn't quite get those face-to-face meetings that they needed. They assure us that these deals that they saw that were not done last year, they hope will be done this year. They believe they're still in the pipeline and it was just a case of a delay. But of course, we wait to find that out this year. Our top 10 holdings on the left, Sabre I will mention in a moment. Rightmove, Recordati, Fortinet and Temenos make the top 5. I won't go through all of these in detail, but I am happy to answer any questions afterwards. Just moving on to the exposure breakdown, and I'll draw your attention to the fact that this is as of the end of March now, not the end of last year. So this is as recent as we can give you. Information technology on the left continues to be our largest weight. And while Will and I do not think of ourselves as running a technology fund, it's because a lot of companies in this information technology sector, which is called or named by MSCI, it is not our definition. Several of those companies, and examples would be Halma, which makes a lot of industrial items like sensors for safety and environment testing, or Cognet, which makes vision systems for automated manufacturing and logistics, or even IPG Photonics, which I've already mentioned, which makes fiber lasers. We wouldn't class these necessarily in the technology sector, but more in the industrial sector. And so for us, that information technology weight of 46 is a little bit overweight compared to how we would define it. But industrials is our next largest at 19, and actually that is up a couple of % from last time, and we'll go through why. And healthcare and consumer discretionary and healthcare are also up a couple of % based on the trading activity that we've been doing over the past 6 to 12 months, and we'll touch on that at the end. The country weightings in the middle is where the companies we own are listed. As you all know, we run a developed market only fund, so we only buy those companies listed in developed markets, and here they are. The US is our largest country of listing at 46%, but it's worth noting that it's actually a smaller weighting than that of our reference index at 60%, so we don't believe that that is at all oversized, bearing in mind that, broadly speaking, in the global economy, the US makes up about 60% of it. But the UK is a large weight at 19%, and that's even up slightly from last year. And the reason we have a large weight in the UK is nothing to do with a home bias. It's more to do with the fact that since 2016 and the resolution of Brexit vote, we have seen somewhat of a discount to UK valuations over the past 5 or so years. Yet we do, of course, have some fantastic companies here in the UK, which we have discovered, and have therefore taken quite large positions in those companies, bearing in mind that we think they're very strong and yet somewhat undervalued. Italy is a new entrant, really, up there at number 3 at 7%. Again, a large weight. We've got a couple of names there. One is new, and I will talk you through that in a moment. And the rest have been relatively similar. But of course, from our perspective, the exposure that really matters to our companies is where they are actually generating their revenue. And we've got that there on the right-hand side. So here you can see it's actually a little more balanced. We've got North America and Europe similar at 38%, Asia Pacific at 18%. And while I did say that we run a developed market fund, of course, some of those countries listed in developed markets do have revenues coming from emerging markets, which is why you see a small percentage there coming from the Middle East and Latin America. Now, as promised, a review of the year to date. So since the start of the year, we've really had 3 key issues affecting the overall stock market and therefore us as well. The first, of course, as none of you could have escaped, is inflation. Now, this was primarily stimulated by the very loose monetary policy we've had for several years, but really has been further exacerbated, firstly, by the supply chain issues that many companies have had since the start of the pandemic. Obviously, when all these factories around the world shut down, as well as logistics, clearly it became almost impossible for some companies to get the supply of raw materials and semi-finished goods that they needed to. And that has continued, and the shortage of that has therefore naturally meant an increase in prices for certain goods. But finally, of course, and most recently, the war in Ukraine has exacerbated that even further and added pressure, especially to commodities such as oil and food. So this is all really now creating a lot of upward pressure on inflation. We're seeing inflation rates of 8.5% in the US, 7% in the UK, numbers we've not seen for decades now. But a reasonable question for you to ask is, how is this going to affect the companies we hold in Smithson? Well, we believe that we will be relatively okay holding the companies that we do for a couple of reasons. First of all, our companies have high margins, specifically high gross margins. And this is the difference between the price you sell your finished item for and the cost of producing that goods in terms of raw materials and labor. So giving an example, if we always sell something for 100 and our companies produce it for 60, as in a cost of 60, therefore our costs are 40, if those costs of 40 go up by 10%, we're going to have to increase our price by 4% to offset that. If you look at other companies in the market, and we'll show you a comparison in a moment, they have gross margins more like 30%, so their costs are 70%. And then a 10% increase in costs, they would have to offset with pricing of 7%, so quite substantially more. And so for the very first reason of gross margin, our companies will be relatively less affected by an increase in cost. The second point is our companies are also relatively capital light. That means they don't have to invest so much capital as other companies to generate the growth and returns that they generate. And that's a positive, not only for the annual returns that we receive, and again, I'll walk you through that, but also it means that year on year, they don't have to keep putting more and more expensive capital equipment into the business. And clearly, inflation is not only going to affect input costs, it's also going to affect capital equipment costs. So that's another way in which our companies relatively escape those pressures. But finally, our companies, for the most part, rely on intangible assets. That is, things like patents, brands, distributions, customer relationships, all of these things that have been built over decades with a lot of money through the past. But it means that in the short term, when inflation is high and prices are high, they don't have to keep reinvesting at the same rate that someone, say, investing in heavy plant and machinery, which has to be repaired, would need to be investing. And that also means that our companies are better at competing. I mean, the primary reason why we choose these companies is their competitive position and our belief in the sustained ability to maintain their high returns on capital, given how good they are at competing in what is, in these small and medium-sized, quite niche markets. And so it's that ability to compete and their competitive positioning which also gives them the pricing power to offset those small degrees of increases in costs that I mentioned earlier, whereas other companies, even though their costs are increasing more than ours, may at the same time not even have any pricing power to offset that. So those really are the three key reasons why, relatively speaking, we think our companies will be better off than the market. Moving on to interest rate expectations, this is clearly a consequence of the high inflation. And things really changed back in December, where several central banks, most notably the Federal Reserve, became decidedly more hawkish, that is, a lot more communicative around the necessity to increase interest rates in the future, based on their changing assumption that inflation was no longer transitory, but maybe more permanent than they first believed. And really you can see how the market expectations around interest rates pivoted around that December, January time period, because it is as market expectations of interest rates move that the market prices itself changes. And the reason for that is clearly in the equity market, the valuations of the equities are based in some large part, some larger than others, on the future earnings ability of those companies. But we do have to discount that future earnings back by some degree of an interest rate. And as those interest rate expectations increase, we have to discount it back by a higher number, and so the value today is perceived to be less. And that's why the equity valuations fall on rising interest rate expectations. But just to put some numbers onto this, at the end of last year, most market participants were expecting around 3 interest rate rises from the Federal Reserve in 2022. Fast forward to today, and all of the rhetoric we've had from the central banks, the market's now expecting up to 11 interest rate rises. That is a very big move in expectations, and you can see the effect that it's had on the overall stock market. A final point that we could make in reference is the US 10-year Treasury yield, which is a rough guide to where people are expecting interest rates to be in the next 10 years. We started the year at about 1.5%, but now that has doubled to 3%. And actually, it's not far off where we started the investment trust in October 2018, but it's been a very big and sharp move year to date. And finally, the point here that I think has only just begun in the marketplace, and I would even go so far as the market hasn't quite priced this in, but it's more what we're hearing from market commentators, is that there are increasing fears of recession, not only in the US, but also in Europe and potentially in Asia. The reasons for that are few. I mean, in the US, we are already seeing slowing economic growth at the same time as these interest rates are tightening. In Europe, clearly, we have already again seen slowing economy numbers, GDP numbers, but we have the war in Ukraine holding us back further. And in Asia, with the clampdown of their zero COVID policy and the shutdowns in Shanghai and now Beijing, people are also worrying about recession with their trading partners too. And so this is really just starting to come through, but I think it's worth noting that in the past, whenever we've seen a US economy with inflation above 5%, which we have now, and unemployment below 4%, which we just have done now, there has been a 70% chance of a recession in the US in the next 2 years. So that's something worth bearing in mind. It's not 100%, but it is quite likely. So focusing on what's happened to Smithson during this time, in that period, our reference index, the MSCI World SMID Index, was down 4%, Smithson NAV was down 17%, and the shares were down 19%. That compares to a slightly better performance in the world large cap space. So we have been relatively punished for being in the smaller and mid cap space. The large caps have done better, which does tend to happen in times of stress in the market. The second point in the middle is the fact that all of these sectors that have done well, clearly energy for obvious reasons, the commodity price spikes, but also materials have benefited from the same trend. All of these sectors are not sectors we would ever consider owning in Smithson, and so the very strong performance has we have been unable to benefit from that, and frankly will never benefit from it, even if it were to continue, because we see commodity industries as very cyclical. We see it almost impossible to guarantee a sustained return on invested capital, and we suspect, as it has happened many times before, that the commodity prices and the performance of these companies will fall as soon as the underlying upward pressure has been released. On the flip side, the sectors that we do focus on, primarily consumer discretionary, information technology, healthcare, industrials, unfortunately for all of us, have been the worst for performing sectors year to date. And again, that is not going to make us change our strategy. This is what we have started doing. We have seen success not only with Smithson doing, with Fundsmith doing before that, and others before them. And so we do believe that through the cycle, this is the best way to invest for the long term. The last 3 or 4 months have been deeply unpleasant and very disappointing for us, but it's not going to make us change anything. And we just wanted to demonstrate to you the precise reasons why what we own has done so badly, and therefore why Smithson has done badly. And on the far right, just to give you some more detail on that, we have again given you the top contributors and the top detractors just for the first quarter of this year. Now, funnily enough, I said I'd come back to it. Here is Sabre, suddenly our number one position. That is because as the Omicron variant has, well, it hasn't died away, but as people have become more comfortable living with COVID, and more importantly, government restrictions around travel have been reduced, we have discovered a surge in consumers' appetite to travel. And not only for tourism, we're even starting to see business travel come back. As offices open up again around the world, it does appear that people are choosing to travel between them, which is very good news for Sabre, because all of these types of companies do earn a little bit more through business travel than leisure travel. But certainly leisure travel is strong. In fact, Delta Airlines recently said that its March revenues was above March of 2019. So we have gone full circle. And their summer bookings, again, incredibly strong, even compared to 2019. So that's positive, and that sentiment has allowed Sabre to be by far our best performing stock this year, and therefore put it into our number one position in terms of holdings. And we believe it should still remain in that position for now. We feel that there's still somewhere to go for normality to return. Even if it doesn't get all the way there, we still see a lot of improvement yet to come. I'll just touch on the large movers so as not to run you through every name on this slide. So we'll go to detractors. Fever-Tree Drinks was our worst detractor year to date. This really has been an issue to do with the cost inflation for them and choosing not to increase price. So for them, most recently, the increase in material costs have impacted their glass and their bottling costs. But also, they've been suffering for 18 months now on the logistics side of their business. Clearly, they have a lot of bottling plants in the UK, which are shipped now worldwide. In fact, until only recently, they were shipping all of their finished product over to the US to be sold. The US now quite a large business for them. So you can imagine the logistic cost involved with that. Now, fortunately, they have bottling plants in the US, so that's taking the weight off that. But it's the logistics and packing material costs that have hit them the hardest. And I say they've chosen not to offset that. That's because they are by far the largest player in their space of premium tonics and mixers. And they believe, probably accurately, that by holding prices where they have historically, they will be putting a lot more pressure on their far smaller competition, who are also suffering from the same costs and certainly can't put up their price if Fever-Tree is doing nothing about it. So that is a calculated move. They do tell us that if things were to get much worse, they will, of course, choose to offset some of that. But where margins are at the moment, they can live with that slight pressure. Massimo, this has been quite an unusual one for us and has involved a lot of work and a lot of attention. We hope we're getting there, but Massimo is a medical device company which traditionally has made sensors mostly to go on the end of your finger to measure blood oxygenation levels and heartbeat and so on. And they have by far the best technology in that space. But most recently, they went out and acquired a company called Sound United, which is a company that produces stereo equipment like Denon, like Marantz, like Bowes & Wilkins, and it really is as bizarre as it sounds. However, the market, as you might understandably think, sold off the shares by almost 50% in very short order after this acquisition was announced. We were very upset, as you might imagine, and we spent a lot of time getting hold of the management and trying to ascertain really why they would go ahead and do this. And they haven't been able to confirm everything now, they tell us, for competitive reasons, and they will reveal all in September at an investor day. However, we are fairly confident that, having done our own research around it, having had snippets back from the management to tell us where we are on the right track, we believe that they are going to take this stereo making equipment and repurpose a lot of their technology into sensors, not only for hearing, as in to augment hearing, but also to provide sensor readings, as they have been doing from the finger, instead from your ear, which turns out, I didn't know, is the second most sensitive place to take sensor readings after your finger. So what we believe is they're going to use the form factor of some of these headphones that have been provided by these companies, plus the connectivity technology that Sound United has developed to link all of their audio products with those in the home. And we think they're going to take all of that and make new hearing devices along with sensor devices for the ear. Now, we don't have that for sure, management won't tell us, but we wait to find out in September, and based on that fact, we are happy to continue holding, bearing in mind this is still a founder-led company who has done tremendous job in positioning this company in medical devices, and we are giving him, for the moment, some benefit of the doubt that he will be able to do this in ear sensors. And then finally, one other I'll just pick out, which is IPG Photonics, because I've mentioned it a couple of times already. This is a company that, although is based in the US, it does actually have quite a large presence in Russia in terms of manufacturing. So up to 30% of their employees are based in Russia. That is because they ship raw materials to Russia, assemble them at low cost, or part assemble them at low cost, then ship them out to Germany and the US for final assembly. And clearly that has been hurt by the Russia-Ukraine war, not actually in fundamentals, because they're telling us that they have not had any products stopped either going into or out of Russia, but the market sentiment has hit the shares. They continue to think that it should be okay given the current sanctions, but are preparing, in case of new sanctions, to completely move their manufacturing out of Russia, which they believe they can do over the course of 9 months. So we are waiting to see their progress on that. And then finally, I just wanted to give a review of the strategy. I know you will know it well, but particularly how we are executing against that strategy. So, of course, our strategy is we buy good companies, we don't overpay, and we do nothing. And what we mean by good companies is those that have high and sustainable returns on capital employed, that have strong margins and produce the majority of their earnings in cash. So the best way that we can communicate this to you is by amalgamating all of our companies as if they were one and showing you the fundamental metrics for that one amalgamated company. So you've got Smithson Investment Trust on the left and our reference index, the MSCI SMID index, on the right-hand side. So the return on capital employed, our primary measure of quality, you can see here is 33% on average for Smithson. And that's even excluding Rightmove, which is over 180%. We thought it was unfair to skew the numbers. So we let them out and gave you the rest at 33%. Clearly, compared to the index, that is far superior. Gross margin, as we were discussing earlier, for ours is roughly that 67, 70% that we were talking about. And the MSCI SMID is around that 35%. So again, those companies are going to be suffering far more from inflation than ours will. And operating profit margin, this is a slightly unfair comparison, 24% for us. I don't think the index is really 1%. The issue is that we have to go through the index of 5,000 companies, generating all of this data and matching it to our proprietary metrics. And bear in mind that it is slightly backward looking because we were taking the last reported data for these companies. We can't, of course, cover and analyze and forecast all these companies. So we're taking the last reported number. I think 1%, therefore, is probably taking into account mostly 2020, and so is a slightly unfair comparison. We, too, have doing the same time period on ours, but we know exactly what ours have done. This is more of an educated guess. I think as we go on, that will spike back up to, we're expecting it to be about 5 to 10%, but still far inferior to our operating profit margin of 24%. Cash conversion is very high, above 100%. How can that be? Well, there's two reasons. First, cash can be higher than your profits if you are receiving cash from your customers before you have to pay your suppliers. Therefore, there is a pool of cash sitting in the company that isn't technically yours, but does mean that the numbers appear that you're receiving more cash than profits in any given year. That's the good way. The less good way, which does affect some of our companies, particularly those in software, is that many companies choose to pay their employees using share-based compensation. That is, they allocate them shares in lieu of cash. And so that means that when a company reports its profit, it doesn't report all the shares that they have issued, or so I should say in the P&L, all the shares that they've issued to their employees, whereas if they've been paying them in cash, obviously that would have been a cash cost. So that means at the end of the year, it appears like you've got more cash than profits, but the reality is you've just issued shares instead, which at some point in time will, of course, become a cash consideration if you start buying those shares back. And finally, we've put interest cover here as the metric for the balance sheet, simply because on average, our companies are net cash. They don't have debt. We do, of course, have some companies with debt, but on average, they're net cash. And so we put interest cover here because it's a meaningful metric. But again, you can see the strength of our balance sheet relative to those in the index. The second part of the strategy, don't overpay. This is a history of the valuation both of the Smithson Investment Trust since inception at the end of 2018 and the reference index. You can see that through time we have generally been at about a 10% premium, been 10% more expensive than the index, but that makes sense to us and is perfectly comfortable for us, bearing in mind how much better our companies are than the average in the index. The end of December, things looked more highly valued with only a 2% free cash flow yield for the trust versus 2.5% of the MCI world. That's because we did see a marked improvement in performance just in the November-December time period. Of course, if we were to fast forward to today, we haven't done the calculation in detail enough to write it down for you, but our rough feeling is that we are more around the 3% range than 2%. So given that the shares have fallen and also our companies fundamentally have continued to be strong, even in the reporting season we're now in, we've seen companies reporting good growth in profits and cash flows. So that combined with the share declines means that the free cash flow trading that we're trading on is probably around 3%. And then finally, do nothing. Well, we try to do nothing. It's very difficult, and this is actually what we have done, which ultimately is very little. In 2021, we sold 2 companies and bought 2 companies. Rollins is a US pest control company. Wingstop is a US-based franchised food company which focuses on chicken wings and chicken thighs. And we sold 2 companies, Abcam and CHI Hansen, primarily for similar reasons, although they are very different businesses. So Abcam is a UK-based medical device or medical technology company. They produce antibodies for medical research. CHI Hansen, on the other hand, produce bacterial strains for food processing and production. But the reason it was similar is because both companies are embarking on new growth strategies into slightly different areas compared to their core business. And we feel areas that are not only expensive to invest in, they have been investing a lot of R&D and also buying acquisitions at very high multiples, but also we feel that the competitive dynamic in these new businesses is a lot worse than in their core businesses. So they're spending a lot of money getting into new businesses, which are growing, admittedly, but we worry about where those businesses will be in the next 5 or 10 years in terms of competition. And just to show you what we've been doing this year, we've added 2 companies, Moncler, which is an Italian fashion and brand company, and Adtech, which is a Swedish industrial company focusing on everything from power systems to industrial processes. And so that is very much in the industrial space. And we sold A.O. Smith, which, as I mentioned before, is a US industrial company creating water heaters and boilers. Over the year, last year, turnover was 9.5%, which means if you do the maths, on average, we are holding our positions, or should be, for 10 years, which is roughly how we think about it. And I would note that that 9.5% is much, much lower than the average in the asset management industry. And we issued 30.3 million shares for proceeds of 534 million, which were deployed into those new positions and also existing positions. Fast forward to this year, we don't yet have the voluntary turnover numbers, but we have issued 5.4 million shares, mostly at the start of the year, and for proceeds of 93 million, all of which was done at a premium to NAV, the average of which was 1.2%, so that it was slightly accretive to shareholders.
Thank you. That concludes the formal business of the meeting. I do thank you for attending, and I would now like to invite you all to join the board and the investment manager for refreshments outside.